Hi, everyone. Welcome to another Barometer webcast. I'm Pamela Hastings, and we have quite an afternoon lined up for you. We are under a week away from the U.S. presidential election. Joining me today is David Burrows, Chief Investment Strategist at Barometer and President of Barometer Capital. David, good afternoon.
Good afternoon, Pam. Thanks so much for opening up today, and welcome everybody to the call today. I'm sitting here at the Barometer North office. It's a beautiful sunny day outside. It's a lovely autumn day. I wish I could say the same for the market. It was a little bit bumpy today, but we'll talk through some of those issues. We're here in the last week of October. We've talked over the last few weeks that seasonally you can expect some bumpiness, especially headed into an election. Frankly, it has been more calm than I might have expected over the last month. But we had a bit of bumpiness today. Market was down a couple of percent. Europe was a little bit worse. Just by way of backdrop, I think that people know we believe we're in a structural bull market, and structural bull markets go on for a long time. They are not without bumps. They certainly come along the way. In the 1991 recession, the 1987 crash, which is certainly nothing like now, the pullback in 2015-16, but they tend to have sort of one step back and three steps forward. And from the correction early this year, markets had a nice bounce, and here we are at seasonally sort of the weakest period of the year. If you take a look at a closer picture, market came out of consolidation that it was in from 2000 through 2013. This is the S&P 500, probably the most important stock barometer in the world, and arguably the strongest market in the world. And we're right in the middle of this long-term channel that we've been in now since 2013. NASDAQ also has been quite strong, but it didn't really break out to new highs till 2016. And certainly there have been some bumps along the way, but we are certainly around the top end of the channel that we've been in since then. Last time I was on, I did highlight that we are headed toward the fourth quarter, we into the fourth quarter, and that when the third quarter historically has been strong, invariably the fourth quarter is also a strong one. And I don't think you can never say never, but that's a pretty good record going back to 1950 when the market was up over 7.5% in the third quarter. But that doesn't mean you don't have bumps along the way. And what the market hates the most, of course, is uncertainty. So let's talk a little bit about some of those uncertainties. It's been a little bit bumpy over the past week. We've had 5 or 6 days down. Today was a weak day, really driven by weakness in Europe. We woke up this morning to Europe being down about 4%. They are having a very significant resurgence of COVID, and that shook our markets a little bit. There was some follow through, and that tends to be the case when Europe opens down pretty hard. So let's just talk a little bit about this week. I think that there are quite a few people who held out hope that we would have some fiscal stimulus agreed on by the Democrats and the Republicans. It appears that a lot of that was talk, and I have no doubt that whoever wins this election will fairly quickly talk about the stimulus that they would like to introduce, whichever brand that is going to be, depending on who wins. And that would join what's happened on the monetary side, some very, very significant stimulus. We know that stimulus has been very, very important to stabilizing markets in difficult times. And we know that there has been an enormous amount of liquidity thrown at this market that partners with the roughly $4 trillion in cash that's sitting in money market funds right now, on the sidelines of the market, looking for an opportunity to come in. We know that there is uncertainty around the election, and I think this is probably everyone's favorite topic to debate. It's been a long, difficult road. It feels like it's been 4 years leading up to an election, and invariably, as soon as it's over, it starts again. But this one has been particularly contentious. I think that there are some that thought we might see some kind of a blue wave, a Democrat rollover of the Republicans. That appears to be getting a little bit tighter. And I think the main concern is that when we get to Tuesday, there will not be resolution. There have been a remarkable number of mail-in ballots. In fact, as of today, over 50% of the number of ballots in total that were cast in 2016 have been mailed in. So we know that depending by state, when the counting begins, and we know by state how long after the election ballots can continue to come in. And this could be particularly important in some of the swing states. Now, when we look at what's been going on, big state is Florida. Republicans have been making a push there, and we've seen Trump's numbers certainly get better. On the other hand, Pennsylvania numbers are favoring Biden by now almost 14%. But the net of it is the race is getting a little tighter as we get closer to the election. And we all remember the surprise that took place in 2016. Over the course of the last week, Republican candidates' odds have been getting a little better. Democrats' odds getting a little worse. Still the spread pretty significant. But as a reminder, in 2016, the betting markets gave Trump a 15% chance of being elected. We're sitting right now at about a 40% chance of Trump being elected. So we don't want to count any chickens as to who might win until we get there. So I think that this is one of the concerns. Will the election actually be resolved on Tuesday? Could there be any significant conflict that comes out of that, legal or otherwise? And I think investors are sort of sitting on the edge of their chairs there. Just remember, though, that the thought was last election that if Trump was to win, the market would sell off a quick 10%, which was clearly not the case. It kicked off a very significant rally, not necessarily because it was Trump. It's because the market was set up to rally coming in. And we talked about the fact, I remember in 2016, frankly, from summer through October, despite the fact that there was some bumpiness, economically sensitive groups had started to behave better than they had been leading up to that point. Following the election, they continued on that path. Now, we've talked over the last few weeks about the fact that economically sensitive groups in general have been showing some improvement. And that's not clearly because there's a big expectation that Donald Trump is going to win and the Republicans. It's because there are some things that are getting better. But everyone wants to focus on the election. And of course, today we talk about the risk of the COVID resurgence, and it's right in our faces what's happening in Europe. And then if we are to see a significant resurgence, what kind of impact could it have on earnings? So here is a recent chart of the Western Europe in black, COVID cases, which clearly are very troubling. The cases in the US, which have tipped higher. And interestingly enough, the cases in China along the bottom. So clearly they're doing something right, or we're not hearing about the numbers. But Western Europe is definitely getting worse. The bigger question is, what about the death rate? And we're seeing quite a tip up in Western Europe. We're actually not seeing a tip up in the death rate in the US. It does appear that the medical system and the healthcare system is handling this part of the pandemic more effectively than they did in the first wave. So that is a potential positive. We know that there are potential vaccines on the way, although it doesn't appear to be right away. And there certainly have been some improvements in therapeutics, some therapeutics approved this week. So the question is, what kind of impact might it have on earnings? Now, we know that companies coming into the last 2 quarters have been very reticent about giving guidance. And as a result, analysts have hedged their bets coming into earnings. And this quarter, like last quarter, companies in general are coming in surprising on the revenue line, an average of 3% versus estimate, and beating significantly on the earnings line. That doesn't mean the earnings are great relative to last year. They're down fairly sharply, but they're coming in ahead of expectation. And of course, companies continue to be reticent to give guidance. And I think that that is a concern, that analysts don't have a lot of takeaway to go out and raise their numbers. But that will be something that we'll continue to watch as we go through the earnings period. However, we do have, I think it's $13 trillion worth of market cap reporting on Thursday by the name of Facebook, Amazon, Google, and Apple. Okay, so we talked about the fact that the market has been consolidating right at the very bottom end of the range. We take the NASDAQ to similar cup and handle picture. This does include the trade from today. We are in this little downward consolidating pattern. We will resolve one way or the other. So our job is to try and assess what the risks are and where things are going. As it sits, we continue to be in that consolidation. This is a near-term picture from the 12th of October through this afternoon, and we'll see where we go from here. We certainly are watching very, very closely. What matters most to us is what's happening from a breadth perspective. As time goes by, are more and more stocks participating in this market rally, or are we seeing deteriorating breadth? And that's, of course, what we look at underneath the surface to say, is there money getting put to work? Or is there a preponderance of money coming out of the market? So here's what we know. As we sit today, the percent of stocks in uptrends has been rising into this week globally. This is for all equities globally. We know that in the US, also it's rising. I can see that I didn't change the title on this one. But so breadth in the US market has also been good. A week ago, we said that our long-term breadth models were positive for the US and improving. Global breadth was improving, and that our short-term indicators, percent of stocks trading with a positive weekly momentum, percent of stocks making new highs versus new lows, percent of stocks trading above their 150-day moving average, were all improving. We have seen some weakness in some of our short-term indicators this week, as we have had some bumpiness, but the long-term indicators have remained positive. So we have seen some impact in our short-term indicators. As you might expect, S&P has pulled back about 7% from the highs. But frankly, compared to other Octobers, that has been a relatively benign experience. So now we head into a seasonally stronger period. If we look around the world, just to give a quick summary, Asia Pacific continues to be positive from a breadth perspective. US continues to be positive. We are less sanguine about Latin America and Europe. Europe has been quite weak. Europe was down close to 4% today. So let's look at the leading groups and see how they're doing relative to the market, because certainly we pulled back over the last 2 weeks. But let's take a look. If you take the group of stocks that have had the high momentum or have been leadership within the market, this is an ETF that houses a basket of higher momentum securities. You can see that as of today, we made a new relative high. This line portrays whether this security is behaving stronger than the market, it would be a rising line, or weaker than the market, a deteriorating line. New relative high versus the market, despite the fact that we're pulling back into these moving averages. So what is that made up of? Well, certainly software is one group that has been leading the market, still sitting really at relative strength highs. So no major change there. Microsoft reported today good numbers. They were careful with their guidance. The stock certainly pulled back, but continues to be a significant position for us. Consumer discretionary, another group that has been leading the market, has had fairly steadily rising relative price strength versus the market. Certainly pulled back. We're back in and around these moving averages. We're starting to get sold out from a correction standpoint, but making new relative strength highs. Within that group, certainly the online retailers continue to be strong. So as you know, we're all about finding structural themes within the market, and we want to stay with them as long as they are relatively outperforming, as long as fundamentally the companies are reporting at or ahead of estimates and continuing to look better. We look at companies that are showing an improving ability to pay us or an improving ability to grow. So clearly, Amazon is going to be an important report tomorrow night after the close and gives a lot of color on this group. But Shopify, of course, is another favorite of ours, continues to behave quite well. New relative strength high today. In healthcare, medical devices, new relative strength high, certainly pulling back today, but has been very, very stable against a weakening market. Genetics and biotech, again, over the past week, while the market has been sloppy, has been very, very stable, trading in around the moving averages, relative strength new high, no change here. A couple of changes, though, we are seeing. We talked a little bit about this a week ago. We started to see some relative price improvement in the banks. Now, if we think that we're headed off an economic cliff, it is unlikely that the banks would be rising from a relative standpoint versus other groups. But we have seen some improvement here. Very strong week last week, certainly pulled back over the last couple of days into the moving averages. This is going to take some time to work through, but this is a group that will benefit on the other side of COVID. Okay, other groups that are sort of riskier assets that have been performing well, how are they standing in? Well, this is an ETF that is in emerging market securities, rising relative strength over the last 2 weeks, a new 6-month relative high. And in fact, emerging markets acting almost better than the US market is right now. Again, pulled back into moving averages. So certainly consolidating. But when we go through some of these areas, the Chinese consumer certainly benefiting by the fact that COVID appears to be more under control in Asia, but sitting right on a very short-term moving average, making a new relative high today. And Chinese internet companies, again, new relative strength high today, no change here. So these are quite interesting. These are good barometers for risk appetite. Now, the other thing that we would expect is that if we thought the economy was going over the edge of a cliff, or we were about to get a lot worse, we'd be getting a big rally in the bond market. Surprisingly, today on such a weak day, the 30-year bond was up only 5 cents, which really is not much of a move. So we saw the long-term bonds sell off, meaning yields have been going higher. We're making lower lows and lower highs. Again, this doesn't point to the fact that we have a major problem sitting in front of us. Now, nothing says that all of these things have to remain constant. We look for signs that something is changing, but we've talked all year long about what the leadership is in this market, and all year long it's been consistent, with the exception to the fact that we have started to see groups that would benefit in a stronger environment start to participate, like some areas of industrials, some areas of financials, emerging markets, more risk accepting assets, and commodities. So the fact is our weightings aren't changing dramatically. We are sort of sitting on our hands a little bit through the course of this week, because we know that if the thing that investors hate the most is uncertainty or unknowns, we're going to see some resolution over the next 7 to 10 days. We're going to certainly have a clearer picture of earnings. We've had about a third of the S&P report their numbers. We're going to get some very important companies today, tomorrow, and beginning of next week. So we'll have a clearer picture on the biggest companies' earnings. We're going to have an idea as to whether or not this election has been resolved next Tuesday, or a good indication that it's being resolved. And then we have seasonality kicking in. October 28th tends to be the low ebb in the fall cycle. And so here we are exactly there today, and certainly a weekday today. We're going to continue to watch our indicators. We're going to continue to see if the strongest groups hold up relative to the market, if the US market continues to hold up relative to global markets, if the Chinese market, which is certainly a risk asset, continues to hold up. And we hope to think that we would see some resolution in some of these issues. Now, COVID is going to go on for a long time, but that is not something that people haven't been worrying about up to this point. Certain industries benefit, certain industries are hurt. So we're going to watch those things. If things start to weaken further and our indicators turn negative, we'll get more defensive. We've not been putting on new positions over the past week. We've reduced some exposure in a few of our mandates. We're in a more flexible position. And like you, we will look on with great interest to see what happens over the course of the next week from an election standpoint. So this is a step-by-step process, and we can't make binary moves. We can't guess at what might happen next. We can only use the tools that we have to incrementally recognize change and be able to tactically orient the portfolios. But at this point, it continues to look as though the longer-term backdrop is favorable, and it shouldn't be a surprise to anybody that the week before the election, we're having some bumpiness in the market. With that, Pam, I'm happy to take any questions.
Thank you, Dave. Would you be able to comment on your view of gold, and in particular, Nova Gold? I know it's a name we've talked about in the past.
So the golds have been consolidating over the last 2 months. On days when the US dollar is particularly strong, gold has been backing off. It backed off about 1% today. They had rallied, the gold stocks had rallied to quite a bit above their long-term moving averages. And as we sit today, many of the gold and silver companies are pulling back in and around the long-term moving averages where they should find some support. The thing that we know is that whoever wins this election is going to bring forward additional stimulus and push additional liquidity into the market. And so that is the perfect scenario for precious metals. We know that commodities in general have been improving. Copper has been very resilient and moving its way higher. So the whole complex, after 10 years of being out of favor, is working its way in the right direction, but certainly there's going to be corrections, and gold is going through a consolidation right now.
Dave, could you comment on alternative currencies? I've received a few questions on Bitcoin and our approach and thoughts on Bitcoin.
It's a great question. So Bitcoin would play a role very similar to gold. If you believe that central banks and governments are going to continue to debase paper currency, then there's a few things you can do. You know, the history is when currencies are being devalued, equities are a great asset class to own because they have the ability to raise price if you wind up in an inflationary environment. We also know that gold tends to be a good store of value, and Bitcoin plays the same kind of role. It's an asset that can't be replicated easily. So if there's a limited amount of it, it's not like paper currency where the Fed can say we're going to push a whole bunch of new printed money into the system. It could be a store of value. It has been performing very strongly relative to other assets. And so I have about a 6% weight in one of the portfolios currently in Bitcoin, and it's acting very well as a shock absorber.
Final question, Dave. If you could just comment on the year-to-date performance of the pools. I know we touch on them briefly in conversation, but leading into the election, how are we situated? I mean, we've covered how we're situated, but just in terms of a comment on performance going into this election.
So from an equity perspective, the long short and the equity portfolio have been knocking the cover off the ball way in excess of the market's return over the course of the year. So that's going very well. From a balance perspective, low volatility perspective, the equity component has been strong. It has a mandate to hold a certain amount of fixed income. The fixed income has been a little bit of an anchor, but keeping the volatility down. The income portfolio, if you compare it to the Dividend Aristocrats Index of dividend paying equities, performing exceedingly well on a relative basis there, because as we've talked about, dividend growth has been outperforming high dividend stocks. The macro portfolio has been very disappointing, but we talked through the course of the last few months that we were set up to make sure that if things got difficult, it would be in a defensive position. And I don't think that any of us expected this year to be as strong as it has been, so that's been disappointing. In general, that's a smaller piece of most portfolios. I think that it's a very flexible strategy that can do well in a lot of kinds of environments, and it has in the past, but playing a little bit too much defense has been difficult there. But in general, if you take those, that's been the case. The separately managed accounts have done exceedingly well ahead of their benchmarks for the year, both in the income mandate and the tactical mandate. So I'm pleased in general, and I look forward to getting through this next week or two, and as we get some of this uncertainty resolving and be back in a sort of somewhat more normal environment.
Thanks so much, Dave. Well, we look forward to having our Wednesday afternoon call next week. That will be unique to see what happens, and I know we won't have necessarily results in place, but we will be able to see how the market has digested what it has of the information it has had to absorb. So with that, Dave, we don't have any additional questions. So thank you so much for your time, and I'll leave the last words with you.
Okay, well, listen, we will update in between meetings if there are significant changes. I get the distinct pleasure of doing BNN tomorrow at lunch, the 12 p.m. show for an hour. So that'll be an interesting time to be doing it. Well, one of the top picks may be a little bit of cash. And so we'll see how that all goes. But thanks everybody for joining in, and hopefully this is useful. And if you've got any other questions, specifically contact one of us, contact me. I'm happy to jump on the phone and answer any questions that you've got. So thanks so much for tuning in.